Welcome to TheoTrade. This is Don Kaufman. It's July 7th, 2023. Just about 23 minutes left inside of this holiday week of trade. S&P futures right now, well, they're up some 550, which in my book qualifies us as massively unchanged. This weekend update: when good markets go bad. We'll explain that and much more here, of course, on the weekend update. Let's start to break down some of the trade. Look, this week, there were only 3.5 trading sessions. It's kind of fun, the half a trading session in there. And I got to tell you, for 3.5 trading sessions, it's a lot of volatility. Even today's trading session, SPUs were up 30 handles. They faded. We rallied. We laughed. We cried. We had non-farm payrolls, which was all kinds of craziness this morning. You know, interesting and ironically, if you take a look at the tape here, specifically the volume, it almost looks like the marketplace opened at 8:30 a.m. Eastern time because the volume was rocking off the non-farm payrolls. But before I get there, as I said a moment ago, quite a bit of volatility throughout the course of this week. In fact, for that, we're going to cruise over to a 30-day 1 hour. And the reason that I'm bringing that up is markets lately, all right, we rallied up, we kind of flattened out. And as I said, throughout the course of, this week, some degrees of volatility hitting that marketplace. The S&Ps got hammered a bit, of course, on Thursday, following an ADP report, which I'll mention a little bit more about. Right now, let's just talk about the fact that it's supposed to be a quiet holiday week of trade. Volatility hits, we rally back up, okay, and we're fading right now again into the close. So one of the first things I think to make mention of is that in the overall tone of the markets, the S&P 500, it did in fact take a mild hit. Obviously, there's still 20 minutes left to the trading session, but when I say that the S&Ps took a mild hit, I'm talking about on the week. So this is, I think, fairly critical to kind of understand and give yourself a little bit of orientation, right? Last week, we exploded outside the expected move. Basically, it's coming into like a 2 sigma move. And what that basically means is, again, if there's, if you're expecting like a $50 move in the S&Ps, and all of a sudden you get, for instance, a $100 move at the end of the week, that's like a 2 sigma move. Well, this week, okay, you kind of say, well, things kind of quieted down. Oh, look, we had plus or minus approximately a $53 expected move. And again, the expected move is that the option marketplace, the biggest option marketplace out there is the SPX, right? It's how the option marketplace depicts risk. So, of course, every Friday we talk about what the expected move is for the next week. Speaking of massively unchanged, look at that. We literally are massively unchanged. Nevertheless, we had this $53 expected move, and it's 3.5 trading sessions. What do we have here on Monday? Basically nothing, okay? Monday was a half trading session. Of course, on Tuesday, it's July 4th, the holiday. We're closed. On Wednesday, a big nothingness. On Thursday, all the volatility gets packed into one trading session. We actually crossed outside the lower edge of the expected move. And today, we actually tagged the lower edge of the expected move at the open. Okay, rallied back up almost to unchanged on the week. And we're fading right now. And I find it, again, quite interesting. But overall, the S&Ps are down and very close to the lower edge of the expected move. But net, people, it's still a rather mild hit. And talking about the lower edge of the expected move, I would not be the least bit surprised to see us actually come right down in the SPX. This is SPX terms I'm giving you. 43.97. 43.97 is the lower edge of the SPX expected move. One of the things I was talking about on last weekend's update was the fact that we actually had 1 breach, 2 breaches, 3 breaches, and if you actually start seeing a breach in consecutive weeks, kind of as an area of efficiency moving to a period of inefficiency, does that mean we're going to breach today? Well, we need quite the little sell-off here with only about 19 minutes left in the trading session. People, though, it's plausible. We may see a little bit of a breach of the expected move, and the market's kind of getting ripped apart, if you will, at the seams. I don't know about you, but I'm kind of excited about the project out there. Now, lo and behold, even though I'm saying, yeah, the S&Ps are taking a hit, I want you to realize something about Nasdaq, okay? Because at this point in time, I think it's critical to tell you, look, the Nasdaq is in the driver's seat. It doesn't matter what you think about financials, right? I'm heavily into the financials. I'm heavily into energy sector. I got positions everywhere. Doesn't matter. All that matters right now is big tech. And when it comes to the Nasdaq, specifically, we're going to look at the QQQ here, and we're looking at auto expected moves. I want you to see, like, all right, the week started, okay, right here, okay, and we're lower, but it's mild. Again, the S&Ps, the point, and the only point I'm trying to make, and forget about levels right now, it doesn't make a difference. The only point that I'm trying to make is it's the S&Ps that took the hit. It's not big tech that took the hit, right? So how is that possible? How's it plausible? Okay, it has a lot to do with, well, here's the financials. They took a little bit of a hit. Taking a look at the energy sector. The energy sector, ironically, will finish the week almost massively unchanged. Okay, but there's a number of sectors throughout the course of the week. And again, I'm just going to cruise around for a second, take a look at like XRT. It's, for the most part, unchanged. It's just a number of sectors and individual stocks, okay, that did, in fact, take a hit. But again, without going into every single ETF and every single sector, the most important, okay, aspect of this in summation is that tech didn't take the hit you thought it was going to. You might see that the S&Ps are going to be down on the week and everybody's going to get all hopped up. It's time, okay? But again, Nasdaq did not take the larger hit. The S&Ps did, okay? Now, markets are stagnating until tech says otherwise. And that's absolutely one of the most critical points that I can make, of course, in this weekend's update. From there, we're going to talk about when good markets go bad. One of the aspects that we're still dealing with extensively in this marketplace, okay, has everything to do with good news is still quite horrific for the markets. And not so good news or even bad news is, well, a market that may actually rally. That's really what the title means on this weekend's update. When good markets kind of go bad, I'm not talking about, being bearish or being bullish in the marketplace. But one of the things that still really resonates with me, and the point to be made over here is, so you've had the jobs number, the non-farm payrolls that effectively came out this morning. Okay, non-farm payrolls this morning came slightly under the estimate. For those of you that are like, non-farm payroll geeks, I think it was 209. Okay, it was the actual, and I believe it was 230. That was the estimate. So we actually missed very slightly. And the knee-jerk reaction, and again, I want to zoom into this so that everybody understands exactly what I'm referencing. The knee-jerk reaction was some sell-side activity in the marketplace. Obviously, throughout the course of the day, we kind of recouped that, and we're fading right now. And there's an interesting irony, throughout all of this. Okay, from when non-farm payrolls came out right here to present time, we're literally, okay, and definitively unchanged. We're unchanged. And this is where not so good news, okay, not so good news was actually, well, good news for the marketplace. We rallied most of the day. We're fading a little bit into this. But the most interesting aspect of this, okay, and the big player in the room is, again, I don't want anybody to discount this. What happened ultimately yesterday, which was on Thursday, and this was the ADP report, which came out, which was absolutely stellar. So think about this. Jobs number comes out, and this is ADP. So ADP does not carry the weight, of course, of non-farm payrolls. Nevertheless, the ADP report comes out, and the market actually starts to sell off. And to be very, very specific with you, it wasn't so much the S&Ps that led that move. It was all about bonds. It was all, okay, about notes. And you had big, horrendous sell-side activity inside of the bond market, inside of the notes, that actually took interest rates higher, and it really started to hammer those markets. So the point, when good markets kind of go bad, it's just that, good news is still bad for the market, bad news is still good for the marketplace. And until this starts to normalize, people constantly ask me, Don, when will you get bullish? okay? When good is good and bad is bad. And I don't mind saying that. I'm not trying to be comical in any way, shape, or form, okay? But you start to realize how twisted, okay, this marketplace is around Fed and Fed policy. Speaking of Fed policy, here's a fun one. At points today, we had approximately a 95% chance now of a rate hike. Again, we are looking at a rate hike. The meeting is July, okay, 26th. I'll remind each and every one of you that just a few months ago, okay, just a few months ago, and you guys can look at all the historical data on here, and I don't want to get, crazy with it, but just a few months ago, we were actually looking at the idea of rate cuts by the July meeting. Now, okay, almost unequivocally, you're getting a rate hike. The probability, again, 92.4% chance of a rate hike. Okay? And the reason that I'm bringing that to your attention is it appears that that is not impeding upon the marketplace at this time, which of course, to me, raises the question, where does the 10-year, okay, interest rate, or the 30-year for that matter, but the 10-year, which of course is denoted, you can look at this on any trading application under symbol TNX, right? When does this become not just prohibitive, but when does it actually break the back of markets, specifically break the back of techs? Am I to believe, because you're going to hear pundits at this point come out of the woodwork and say, rates don't even matter anymore. Tech is that good. AI is going to take over the world. Okay. I don't buy it, not for a second, because I'm going to tell you right now, we cracked yesterday, right? 4%. Okay. That's 4% of the 10-year. Today, we almost cracked to the 4.1%. What a difference a couple of trading sessions can make. If there's one thing that really makes me bearish on this screen, it's right here. There's no question, okay, unequivocally, that 10-year is exploding to the upside. And that's going to make, and that's when people go, well, what about real estate? Don't worry about real estate, okay? Right now, in terms of real estate, look, the supply demand out there, it's not balanced. Nobody wants to sell properties. Okay, home builders are still doing spectacular. That's not the area of the economy we should even focus on at this point. I think you have to look more at the marketplace, and specifically, all the home builders could be out of business tomorrow. It's not going to impede upon Microsoft. It's not going to impede upon Apple, right? The point that I'm trying to make is, it's where does that 10-year? Like, is it 4%? Because you would think that 4% would be a bit of a snapping point. And you start to look back at the 10-year, for instance, over the last 3 years, and you realize where we are right now. We're almost to highs on the 10-year. And there was sheer and utter panic. Last year, which is 2022, wasn't a good year for markets, right? There was sheer and utter panic up here north, okay, of 4%. Interesting and ironically, we're right back up there. We're butting up against the highs of the 10-year interest rate. Again, that's for 3 years. Speaking of 3 years, do yourself a favor. Pull up the 10-year over there. Yeah, it's almost 10-year highs. Wait, do yourself a favor. You just go for it and pull up the whole max chart over here. The last time we actually saw rates at these levels, people, okay, you got to start coming back into early of 2008. You can actually bring it in here. Even 2010, we got back up to the 4% level before we actually collapsed, basically down to absolutely nothing. Nevertheless, okay, I think we're at incredibly prohibitive rates. And at this point in time, okay, if there's a reason to be bearish, this is it. I think you got to watch bonds. You got to watch notes like a hawk. Remember something, just briefly, for those of you that are a little newer here, sell side activity in bonds, sell side activity in notes denotes rates. Interest rates are inverse relationship. Okay. As the notes sell off, okay, the 10-year rate goes higher. Right now, TNX soaring out there. Again, if there's one reason to be incredibly bearish in this marketplace, it is that right there. All right, as I'm actually talking to you here, I'm actually going to pop out of a trade in Microsoft with just moments to go. So on this weekend update, I got an in the money option over here, and we're going to exit it. Hey, look, okay, this is live, filled. All right, okay. So always reporting during market hours. Speaking of during market hours, cruise down to the SPX again for just a moment, because as I said to you, don't be a bit surprised to see us pull back to where. Take a look at this. Like, this is a line that I drew a week ago. And we're coming right down to it. coming home, right to the lower edge of the expected move inside of the SPX. But with all due respect, again, it's only a $53 move to the downside. So it's mild. Meanwhile, back in Nasdaqian land, when I'm talking about the Nasdaq over here, the Nasdaq still, in my opinion, is just not taking a big hit. Right, the Nasdaq, it's not even halfway home to the lower edge of the expected move. So lo and behold, it's not doing a whole lot. All right, so that 10-year being critical. All right, volatility, skew, and negative gamma. I'll make this very, very brief. Okay, you saw VIX move. Now, again, I'm not a proponent of VIX, right? But it's the first time in a long time we've actually seen volatility move. You got VIX in and around like the 15 handle. This next week of trade, I think is fairly critical for volatility. Okay, if we're going to start to really rip, it's got to be next week. Why? The week after that, you start to get into earnings announcements and so forth. But this next week, interestingly enough, there's not much on the calendar. You know, everybody wants to bring, oh, look, okay, there's going to be some big numbers in here. Yeah, one or two decent economic indicators. But even like stuff like CPI right now is not going to be a game changer. It's not going to be a game changer because we're already pricing in a 25 basis point hike. I mean, if CPI came in really, really hot, okay, I think you could actually see a probability of even a 50 basis point hike, right? I'm a big proponent of the Fed rip it off like a Band-Aid and do 50 basis points right off there. But lo and behold, like that CPI, okay, yeah, it's important, but what you're going to find out here momentarily is the expected move for next week. It's not like a vicious expected move. I think volatility is fairly critical. There's one thing that definitely keeps me on the edge of my seat, and that happens to be skew. Skew is incredibly high. All that says, okay, is there's a lot of hedging activity in products like the SPX. That's it. Okay, 30-day options in SPX are being hedged. Now, one of the last points to make over here, I have, okay, seen some very funky order flow start to play out in big tech stocks. Okay, and this could be a sign of a change. And I talked about that extensively, right? But negative gamma squeezes. People always seem to think that that's to the upside. But the order flow, okay, this week, it doesn't look like the prior weeks when we were ripping and rallying. Now, granted, this was a holiday week of trade. So at this point, I'm not going to make a big deal about it. But when I say that order flow looks different, what looks different? We're not getting call buyers rushing the market. And when I talk about call buyers rushing the market, I look here on thinkorswim under option statistics, and I look at the traded at the ask or above. That indicates if you have a market on an option of $3 at 310, trade at the ask or above means I'll buy it at 310. Okay, they'll just buy them at 310 and they just rush the market right at the cash open, buy them at 310, buy them at 310. They buy thousands and thousands of contracts. We're just not seeing that this week. There's been a definitive change of order flow. And lo and behold, earlier in the week, we did see some fairly wild sell side activity, okay, in a number of key tech stocks. And for a brief, okay, and fleeting moment, right, in markets, they recouped, a lot of those losses. But for a brief and fleeting moment, we did, for one of the first times, see a negative gamma squeeze to the downside, okay, which implies the marketplace was rushing in and actually buying puts, okay? They were buying puts. And that, okay, that unto itself can be a little bit of chaos in the marketplace, specifically Tesla, okay? Tesla, some sell-side activity here. I saw the put buyers, they were out. So one of the things that we're going to be talking about extensively coming into next week's trade is, again, the negative gamma squeeze. And what brought us to the upside can absolutely bring this marketplace back down. In terms of a position update, okay, there's not a tremendous number. I actually scalped a lot this week. A lot of our short calls are now maturing very, very well. We're doing, okay, considerably better on calls that we sold. I also happen to roll, okay, a short call over in the TheoTrade small portfolio, okay, but again, not a tremendous amount of trading activity because for the most part, we've been at about a 50, 55 point range. Speaking of range, we're coming home. Okay, look at this. I'm going to end the video here right on the lower edge of the expected move. Oh, this marketplace, it's just doing it for me. Last, but definitely not least, as we mention each and every week here on the TheoTrade Weekend Update, the SPX. Of course, we're on the SPX. This past week of trade, we had a $53.67 expected move in a 3.5-day trading week. Oh, next week, now this is all kinds of crazy. We have about a $59 expected move. The irony, it's a 5-day trading week. Given 5 days, we can only move $59, but at the same time, we saw that kind of volatility in one trading session. Thursday, we had a 60-plus handle move on Thursday in the S&Ps. So strap in. Look, okay, I believe that the bonds, the slightest slippage to the downside in the bonds is going to awaken the volatility beast. For me, okay, that is the focal point in this next week of trade. Bonds, they push down very, very mildly and spark, okay, wild sell side activity inside of major tech stocks. The gamma squeezes start flipping over. They're buying puts like crazy and selling stock to hedge it. With that, I want to thank each and every one of you for joining us every week here at TheoTrade. Have a wonderful weekend. Bye-bye.